So basically, let me recap what we did last time. So it's basically a sort of introduction to risk management. What is risk? How the risk differs from uncertainty, and then we looked at how to set up a someone's. I think mic is on. If you would mute, it may be better if you can. Everybody can mute the speaker. It's better. Otherwise, there will be noises coming here and there, other than when you want to ask something. So basically, then we looked at the enterprise risk management process. Also, how different entities, individuals look at differently. The different attitudes of institutions or people when they take decisions from the risk perspective. Then I think we ended up at, I think, the governance relationship. So let me ask a couple of questions before we move to see whether you have understood the basics, properly. So what is the difference between the risk and the uncertainty? What is risk? What is uncertainty?
When it comes to risk, we know the probability distribution of the events, and in uncertainty, the probability distribution is unknown.
Okay. What is the common in both? The first part is missing. What is the commonality? Both risk and uncertainty is something expected, the actual outcome deviate from expected outcome. So that is whether it's a risk event or whether uncertain event. Both is something that you want to happen, which may deviate from happening or not happening. So there's a risk. Okay, so as an institution, you want your profit to be, let's say, between 80 million to 100 million this year. So there's a risk that whether you could be able to end up with 80 to 100 million. So there's a risk. Okay, the actual outcome may deviate from expected outcome. Whereas the risk, we know with certain probabilities. Okay, there are certain possibilities. So you can have set of possibilities and probabilities. So at least you know where you end up in advance. Okay, so there is a 50% chance this happened, 30% chance this happened, 20. So likewise, a set of possibilities and probabilities. So you can have a certainty about your deviation, the possibility of is happening or not happening, and the final outcome. But in uncertainty, the problem is that you can't predict, because you cannot identify set of possibilities with certain probabilities. So it is more uncertain. And both are events that end up with deviations, but whereas you have some, because then you know in a risk event, you know that based on the probability you can take some risk measures to cover up the risk part, but not in answer. So that's the key thing. And the importantly, no one can ignore certain thing because even now this is if you look at the Captain Smith, what he said in 1907 and then what happened 1912. So that he would have not thought about the uncertainty, you see. So that may be the reason. So we looked at pure risk, speculative risk, and okay, we looked at the classification of risk, different risk classifications. Then most importantly, the enterprise risk management framework. We identified 8 events: internal environment, objective setting, event identification, risk prioritization, risk response, control, information and communication, and monitoring. Okay. Now, once you identify the risk, usually what you do, once you identify the risk event, what do you do?
Categorize according to the velocity of the damage.
Yeah. So what do you go? How is this a simple way you can do it?
Under the risk matrix, we can divide the risk likelihood to occur and the impact of it. According to that, we can divide between the categories.
Okay. Okay. So once you identify, because if you look at a business entity, there can be thousands of risks, but you can't manage or mitigate each and every risk because I mean, if you anybody can simply say risk management. Risk management is not free. Risk management at a cost. Now, if you look at you want to even if you individual you want to take a what do you call vehicle insurance to safeguard, or you want to obtain a fire insurance, or so it's not free, it's costly. Even if you look at a derivative which you want to use for hedging purpose, we will look at later, it's not free. Now, for example, if you want to have option, interest rate option to mitigate interest rate risk, it's not free, right? So that means if you have 1,000 not risk to manage 1,000 risk, of course, then your cost would be much higher. So no point, like say if your risk is the outcome of the risk is, let's say, outcome in the sense loss is 100 million, and if you spend 200 million to manage risk, no use. So risk is not free, risk is at a cost, so that you must identify the most important risk in terms of likelihood and impact, as she said, through a risk matrix. So that's how you prioritize to build up a risk matrix and identify the most critical, important risk that the management fields need to be controlled or managed. So there are 4 methodologies we usually follow. So what are the 4 techniques, not really techniques, 4 ways that once you identify the risk and prioritize, you manage the risk?
Avoid, accept, reduce,
Yeah.
or manage, and share.
Okay. So avoid, okay, if there are events that you should avoid, I mean, the one is that's greater harm to your institution and managing also very costly. So no point taking that sort of a risk. Let's say there's a particular risk. If that happens, your loss would be 200 million. Okay, your loss would be 200 million. Then managing, in the sense, if you want to manage it, again, you have to incur, substantial amount, almost equivalent. So why you take such a risk? So try to avoid that. When you see the risk is extremely significant, which can cause significant loss. And also managing is not easy, and managing itself takes significant, you need to incur significant cost. Okay, so even if the cost is less, but the consequences on other side is dangerous, then it's better avoid it. Then, as you said, accept. So accept means you simply take the risk to your shoulder. So those are risks which are insignificant and impact also. The probability of happening insignificant, and even if it happen, loss would be significant. So you can simply accept. Why you waste your time on spending resources to mitigate that risk? So basically, you do your business activities. If that happens, then you take it. Okay, no, don't worry about managing such risk. Then risk sharing. If you could cover up events like what you call insurance or other shared passing responsibility to other party, maybe through derivative projects, then share it. Okay, so pass part of your risk to the other person. Okay, so it's probably you share a portion and other party bear a portion, but again at a cost. Then try to manage or mitigate the risk which cannot be shared among parties, but have some controls in place, or maybe other risk management tools, so that you can minimize your risk, loss if a risk event happens. So those are important aspects. Basically, this is the risk matrix we discussed. Then we went to the different attitudes, remember? Risk averse and risk seeker and risk neutral person. How a decision could be taken. Even among banks, there may be different risk attitudes. Now, let's say when it comes to credit, there may be differences between the banks. So certain banks may follow risk neutral, certain banks may follow risk averse attitudes, maybe certain banks follow risk loving attitudes. There are, if you look at 30 players in the market, maybe 30 players may not follow the same way, maybe quite different. Right? Finally, we came to the point of corporate governance and risk management, the linkage. Okay. So I think we stopped here. So the obvious questions that are asked when a company collapse unexpectedly, why did it happen, what should have been done to prevent it, what should be done to reduce the risk of happening it. So these are questions like postmortems. Okay, so we will ask many questions: how it happened, why it happened, I mean, why you didn't do this. So these are very simple things anybody can ask. But important thing is, once allowing something to happen and asking question, or like postmortem. So let businesses have systems in place, controls in place, or adopt right risk management, tools to prevent certain risk events happening, or to minimize loss of a risk event. Okay, so if you can try to take measures to prevent it, that's the best. But in business environment, it is very doubtful that you can prevent certain things happening to 100%. You can prevent to some great extent, but at least if you can prevent it to great extent and minimize the loss, that you would be happy. So in doing so, some important things you need to be mindful based on historical experiences. There are many things in a business that could result in possible risk event. Internally, I am referring internally, because certain external event you don't have any control. You can take some measures like mitigating. You don't have control now. For example, when you drive your vehicle, you can internally control many ways to ensure that you don't meet with an accident. But external events you can't control. Whether you drive perfectly, there may be errant, careless person driving another vehicle may knock you down, causing a significant damage. So you don't have any control on the external event. But internally, if you face such an event, try to have some controls internal to mitigate the risk. So any business entity could be, mindful of the fact that they are very much controlled in these events. These items. Okay, these actions. Now, incompetent and dishonest senior management. Okay, so that is very important, because if you look at all these transactions or actions are conducted through the set of people in a business organization. I mean, all employees get connected, but mainly decisions are taken by the board and then implemented through the senior management in the company. So ensure they are competent and honest. Okay, because why it is said incompetent and dishonest, these are experiences. If you look at probably maybe towards the latter part when we discuss the corporate governance area, you will come to know how many international failures has caused due to incompetent or dishonest senior management, right? How these people have contributed to such failures. So that's why I have put it here. So that to have good system in place, ensure you are competent and honest. Because competence is one thing, honesty is one thing. So you have to satisfy both. No point if they are competent, but if they are dishonest. There are smart rogues. No? If you look at especially our countries, there are people competent, but what for they competent? For doing fraudulent things. So competency should not be for doing fraudulent things. Okay, it should be for doing right things. So dominant chief executive officers. Okay, so this does not mean in each institution when there are dominant chief executive officers there are possible risks event, but if you look at many failures that has taken place in the world, there are what you call events that led to significant risk due to the dominance of chief executive officers, right? So that's very important. So let me so if you look at certain failures that when there are dominant chief executive officers, that itself has led to certain failures. So that's why it says the common reasons now. This is not like every institution who have dominant chief executive have failed, but the incident that has happened, they have found that all over the world, right? Then absence, lack of internal controls, right? Whenever your businesses do not have adequate internal controls or internal controls are not sufficient, so that may leave a path for anybody to engage in certain, maybe fraudulent activities or malpractices. So ultimately, could lead to a significant operational risk event. Okay, so this is the next point. Absence of segregation of duties and internal controls are somewhat related. Now, let me explain that and discuss together. Now, absence of segregation of duties. So, what do you mean by segregation of duties? Now, in many businesses, especially banks, this is a very important area. I mean, not only in bank, any institution, but especially in banks. When it comes to bank, certain functions are very critical, and if not controlled properly, would lead to significant risk event. So, in that respect, segregation is very important, right? Now, so if you look at segregation of duties and internal controls are related items. Now, from a bank's point of view, can someone mention a couple of maybe few examples, important areas of your businesses which these two works parallelly? Can someone briefly tell? This is, you can see in your bank's day-to-day operations. So some critical areas in your bank, and this is something important for any business, but in banks we can critically see this in certain areas.
Treasury function. Treasury, front office, middle office, and back office are managed under different sections. I mean, back office under finance for controlling purpose, and the front office under treasury. Sometimes the middle office under risk management. Likewise.
Okay, you are right. So, can you a little bit elaborate? Like, okay, you are right. Now, treasury operations of a bank, very important. So you have, depending on the size of bank, either you have 2 units or 3 units, right? The front office, the middle office, and the back office. Sometimes in a small bank, maybe front office and a back office. So back office do the middle office function as well. Okay, but clearly front office function is separated, right? So that's a very good example she brought in. So I mean, what is the reason? How that segregation, bring in internal controls? So why you have this? Just you don't have for the sake of fun. So no bank would have this system for the sake of fun, but there are specific reasons. I mean, this is part of the risk management. So can you a little bit explain? So how you can control through that mechanism? How you can control? I mean, what is the control you bring in? Okay, this is a key area, right? I think most of you are working in banks, so let me maybe before break have a little bit discussion on where you work and have a little bit discussion, which we couldn't do last week, so that I know exactly how many of our bankers and others were from where they are coming. So what is the control you expect? Perfect, treasury operations is a perfect area.
Transactions are going to be done by different parties in the bank. So
No, what am I right? But how that control was brought in? What
we can mitigate the risk occurred from that if the transaction made by one person.
I can't hear you properly. There's a noise coming.
We can mitigate the risk of if the transaction is made by one person. There's a possibility to cheating or maybe some errors. So we can mitigate that through doing the transaction by separate parties.
Mm-hmm.
Treasury,
Anyone
in
else?
treasury there are in treasury each dealer is given individual treasury limits. So those whether these limits are
No.
adhered.
What I want is when you have this separation, how this risk control comes in. That's what I want to know. Okay,
Okay.
now you say front office, middle office, back office. How this element actually happening when you have this control?
When the front office do a dealing, the middle office is going to check whether all the parameters, I mean the limits and other things are adhered. And when it comes to accounting treatment, the back office is functioning as the accounting authority, so that a transaction is controlled by three different parties, from which the risk of the bank is facing is minimized.
Okay, so let me put this way before I explain again. So if let's say why it is a risk or maybe possible risk if all are under one unit. So I am going back, and so rather than in your bank you don't have front office, middle office and a back office, right? So let's one unit in whatever you call in your bank do all those things, and how it would lead to a risk event. So we have this separation because of a risk control measure. But let's say all are in one unit now. Let's say you have a dominant chief executive say, no, in my bank, I don't want to have front office, middle office or back office. So let all are done by, we call it front office. Okay, the front office do all things. You don't have any middle office, back office. So how then it could lead to a risk event?
If there is a person who is more influenced person is a one unit, then he will control all the function. They will have a influence on the people. To avoid, if there are separate units, is coming a different management and the monitoring purposes and the risk mitigation. There has a separate units to do their transaction. It's monitored by the different units.
Okay. Okay. So I think let me go back again first now. Okay, these treasury operations are a classic example. You have separation because if you look at front office is the place where the traders engaging buying and selling. Okay, so you know the front office are loaded with the traders. So they give quotes based on the transactions bank have. They offer quotes, and you know based on quotes offered by them, there are deals take place. Deals. So basically, that is the place where the buy and sell take place. Buy and sell orders take place. Okay, so the job of front office guys are within the limits they have given. So they have to do some deals. So basically, they identify if they want to buy some foreign currency. They say, you know, let's say I go to the foreign currency part. They deal in foreign currencies. So there may be other treasury operations also. So let me go back to the foreign currency and example, can give example like that. So thereafter, once they do the buy and sell, their business is over. They create a maybe deal ticket or whatever. So their business is over. Then they don't have any other business to do with that settlement or price negotiations or anything. So they negotiate the price or whatever and enter into the deal with another party, buying or selling or whatever, you know. So once they do it, their job is done. So thereafter, they are not worried about, you know, whether the bank has made the settlement, paid the amount or whatever. So then the objective middle office to see whether these transactions are done in line with the control mechanism you had in place, whether they have followed the limits, whether they have gone beyond the limits. Okay. And there are certain other tools and see whether there are other unwarranted risk events or possible frauds related to this particular deals, and then finally, so that is their control, the middle office risk management function part. Then the final unit, they are the people who want to settle the deal. Now, when you say if you want to borrow something from another party at a particular interest rate, you simply enter into the agreement and you simply move away from that. So your job is that front of it. Then finally the back office or the accounting part, so they basically comes to the settlement of the deal. So they check all these things, whether these deal the parties are correct, the whatever the correspondence are right, okay, agreed amounts are correct, agreed rate is correct. All these are checked before making the settlement. Okay, before making. So the three levels, the balances are checks and balances taken place. So the possibility of something happening is controlled to great extent, unless they collude. Of course, there could be possible collusions. What do you mean by collusion? So what do you mean by collusion? Now, collusion is a good example in certain other events of a bank. You see? So basically, the segregation of duties, internal controls, the link is that classic example you all gave is treasury operate. That's right. Okay. So each one has due responsibility to ensure these are within the limits under each party. Of course, let me go to the second part of the question. If all three are under one, all, there's a greater, it doesn't mean everybody will do this, but there's a greater possibility. Now, for example, let's say, forget about treasury operations. So come to a, let's say, simple payment for somebody in your bank. Let's say there's a payment to be made to somebody for some purchase by bank. So how generally take place? How it generally take place? You create a voucher. Okay, there's an initial point. Whenever the invoice or whatever comes, somebody raises a payment voucher, right? So there may be a person who engage in preparation of vouchers based on the document. This is the amount. This is the payment, and then what happened? So that the person who raises the voucher will pass it to a middle office, another person for what purpose? To do the relevant check-ins. Okay. Then it will go to a somewhat senior level officer to authorize it. So there's a preparation stage, checking stage, and authorization. So authorization is done by somewhat senior level officer based on the whatever the controls you have for amounts and all. Then finally, once authorized, there may be a payment check or whatever, let's say check, check is written. So check is written and then along with authorization, there is a check sent to signature. Now check is signed by another level of authorized people. Okay, so that's usually happen. I'm in a simple transaction. So let's say instead of that, let's say one person is given everything. So I am the person who is raising the voucher. I am checking it. I am authorizing it, and I am even signing the check. So then definitely I can do whatever I want. You see, so that's how the segregation is very important in terms of risk management as a part of internal control. So it has been observed in instances where there are failures, the segregation has also, inability to segregate, absence of segregation has led to many failures. Okay. Now, can you give another example of a segregation and internal control, another important area in a bank? Now, treasury is one thing. Another area?
Credit
Very
area.
important area in most of your banks.
Credit area.
Credit area, credit area there may be, but I'm referring to rather than credit, there is another area in everywhere. This is a very important area. I know credit, every area you have internal control, but very specific, internal control you use. Anyone? Your cash operations, wall duties. Now, in your wall duties, how the control comes? Anyone?
The control comes from case officer.
Sorry?
The controls comes from case officer, and
Yes.
also clearing part also internal controls I have.
I am not referring vault. I said cash operations, vault management, vault.
Daily cash out, we have to take along with 2 officers. One is in E grade and A grade. And lodging the cash also, there is a control. And it should be balanced with the strong. And in between that,
But rather
we
than
have
that, I know, but you are right. But rather than that, what is the main important thing? The 2 key holders.
2 key holders. Yes.
Yeah, vault duties.
And 2.
Specifically, you see that there is no 1 key holder. At least minimum 2 key holders. You see, so that is a control measure. If you look at vault functions in a cash operations vault functions, the main control is the key holders. So you have 2 key holders. How the control comes, because they have 2 specific passwords. So one cannot open, let's say somebody want to engage in a fraud, but he cannot alone do it because there is another key holder who has a separate passcode. Okay. So these are, there are a lot of internal controls. All of you referred certain areas, but obvious things you can see, like, where segregation of duties comes as part of internal controls, right? So, I just want to highlight that the common reasons in many failures are absence or lack of these, areas. So then absence of clearly defined reporting lines. Again, when you don't have, proper reporting line system, that also can lead to confusion and taking inappropriate decision, especially when there are people who try to find a way to engage in a fraud, right? Then absence of proper management information systems is very vital in today's context. The management information systems, so that you know the situation of your bank or entity at any time through this system. Okay, so because especially from the bank's point of view, things like liquidity, cash position are very important. Okay, so let's say there's a sudden demand for withdrawals of cash comes due to whatever reason, then you must be able to have an idea about your overall cash position. Let's say if you are a bank with significantly large number of branches, then of course, this MIS will help to gather information fast. Then internal audit. Okay, so whenever, so internal audit of an business entity plays a critical role. But, many places, many colleagues, they don't like internal audit, right? Even in your bank, when internal audit start their, audit operations, many not happy. But if you really look at, if the internal audits are done, in the right way, so this would help to identify the weak areas or the weak processes and weak controls and, suggest the remedial measures. You see, whenever the internal controls or, internal audits are not functioning, then of course there's a greater way that, people can engage in many risky events leading to significant losses. So the person responsible for risk management, the board of directors, has ultimate responsibility in any business entity, and they are the people who should formulate a risk management strategy, right? So for each exposure, the director should decide whether they are prepared to accept the gross risk. If they are not prepared to accept gross risk, they should consider strategy for avoiding reducing the gross risk through control or containment. So once they identify the risk through the whatever the report submitted by the risk management teams, units in the bank or the business entity, so they must decide whether they need to accept the gross risk or if they want to avoid or reduce it by through control or containment. Okay. So if you look at the corporate governance of business entities, the risk management is one element of corporate governance. So the board decides the overall risk management strategy that management will implement. The management will formulate the detailed strategy and will be responsible for and accountable for maintaining and monitoring the controls, right? So the board decides the overall risk management strategy that management will implement. So decision has to be taken by the board after considering all aspects of risk events. And the chief executive officer will be given, CEO will be given the responsibility and will delegate responsibility to other executives. So basically, boards set up the policy or the framework and hand over responsibility to the CEO to implement it. And CEO in turn will share the responsibility, or delegate the responsibility to other senior executives in the relevant institution, right? So the ask questions and develop your approach. So always when you developing a framework, so you can ask certain questions yourself and then find answers. Okay, so the answers will tell what is the approach you should follow. Okay, so you ask a question and you provide answer. Okay, then answers are the methodology. Okay, so generally when you ask questions, it will automatically give the methodology. So what sort of questions at the setting up stage somebody can ask? Do we understand our major risk? So the business entity can itself ask, do we understand our major risk? Do we know what is causing our risk to increase, decrease, or stay the same? Okay. Have we assessed the likelihood and impact of our risk? So first question is whether we know what risk we face and what things then cause to increase the risk, decrease the risk, or stay the same. Then have we assessed the likelihood and impact? Remember when we do the risk prioritization, this is what we do. So have we assessed? Say you are the teams responsible for risk management tells, okay, we have identified 5 major risks. Okay, let's say 5 major risks. So what are the 5 major risks? Let's say the possible, I'll take example of what you call the operational risk event, possible, risk of building collapses. Okay, so based on assessment, there you have identified, some problems with your building, physical, that is operational risk event, building collapses. So have you identified the risk? Yes. And have you assessed the likelihood and impact? So that's the second question. Then have we identified the sources and causes of our risk? Okay, so what are the sources and causes? So why, when you identify the risk, so what is the cause of the risk or the source of risk? So how well are managing? So are we managing risk properly? Okay. So depending on your managing level, then you need to identify the possibilities and probabilities. Are we trying to prevent the downside risk from happening? So are we taking adequate measures to prevent it from happening? Downside risk means losses. Or are we trying to simply recover from them? And importantly, who is accountable for the risk? Because when you identify the risks, there must be people accountable. Okay. In each business unit, there may be different people. Now, let's say you identify there's a possible risk event can take place in a front office due to whatever reason. Okay. Now front office. How these controls are there? I mean, limits. All these are there. In addition, now what other things usually you have in place in a front office? Other what do you call the controls? I don't know, maybe not in all banks, but many banks, this may be these controls may be there. To avoid certain things happening. Even if you have a front office, back office, middle office separation, within the front office itself, still there could be a possibility. Okay, certain, fraudulent thing can happen. So how do you control them? In many, maybe banks, you have certain other controls also. Other than limits, I am referring, I mean, in the book limits or whatever.
CCTV watching.
Sorry?
CCTV camera. Traffic
Yes, CCTV camera. Okay, you are right. What else?
Spot checks.
Spot check is something, even can happen something, but it is, you can do it. Yeah, but I'm referring now, she said a security camera. So that is
Recording of the telephone conversations?
Exactly, recording of the telephone conversation. So these are other significant control measures. I mean, in a front office environment, not in every area of your bank are covered with a security. Now, let's say if you go to some other places, security cameras are not surrounded, in your working environment. But in a front office, there are significant security cameras to record, online recording. Even somebody can monitor from outside what is happening, right? Somebody can monitor what is happening. Let's say there may be a person who is overseeing the front office through the security camera. So he is monitoring and seeing, okay, if there are, like some discussion going between a couple of people, probably he can suspect and he can monitor closely. Then recording. Okay, recording. So generally in a front office area, these are recorded. So anytime these records can be extracted so that anybody who engaged can be directly, identified for the receiving. And also most of places, I think, I don't know, in your banks, you can't take your private phones inside the, what you call, dealing room. I don't know in your banks. Is it the case in your banks?
In the cash operation area, it's restricted to use the personal
Even
mobile.
in the front office, you can't allow, because still then that is a way of, manipulating. You can use your private mobile phones for, something, unwarranted happening. Sometimes those are, I mean, cash operations area, you are right. You don't allow your mobile phones to bring it. So those are physical controls. You see, physical control. So these are the things to in plans to minimize the, even to prevent certain things happening. This is classic examples. From even the front office, another physical control is, can anybody go to the front office to see your friend? What about you in banks? Let's say you have a very good friend working in front office. Can you go to the front office, dealing room or whatever in your bank? Can you or cannot? You should. I mean, it is not possible because if it is possible, then that's a greater risk event. No one can have access to the front office dealing room in a bank. Maybe even you at higher level, you can't. It is prohibited. Now, even in a cash vault, can everyone go to the cash vault? No, it's only authorized people. Okay, maybe cash operations manager, key holders, only those people. Even your big boss can't go in. At their wish, it is not permitted. So there are certain controls. Those are physical controls in certain areas. So it's very important now, once you have these controls in place, of course, who is accountable for this risk? Okay, so once you identify who is accountable for these risks, how do we talk about this? Do we have a common language across branches, across divisions, across the system? So there should be a common platform or common way of looking at risk across the bank, across the branches, across the divisions. Are we taking too much risk or not enough risk? Now, sometimes the attitude may end up with taking too much risk. That is not good. Or maybe not engaging or taking enough risk. Okay, sometimes when you are too much risk averse, you don't do anything. That's also not good. Now, let's say in your bank, your main product is credit. Now, your attitude is like a little bit take high risk. So, when your credit evaluation, you may tend to lend to even persons with higher credit risk or inability to pay. So, you are taking too much risk. So, that's not good. But let's say your bank's, management policy attitude is too much risk averse. It's not risk averse, too much. Then you are reluctant to give a loan to anybody. So you only pick the, high credit worthy customers. So that may also not good because you may not end up with your results, final results. Okay, so you have to have balance. Anything you have a risk, you can't avoid. Okay, but you must not take too much risk, but you must not avoid everything. Okay, every risk. Are the right people taking the right risk at right time? So that's important. In your entity, whether right people taking the right risk at right time, because even the same risk may vary depending on the time. Okay. Same risk may be vary depending on the time. Okay. What's our culture? Are we risk averse or risk takers? Or are we somewhere between? So remember we discussed the 4 business projects, A, B, C, D, D, how the different people selected the different project based on the risk culture, risk attitude. Right? So, our risk averse, risk takers, or in between. So that you have to decide based on your, attitude or the ability to absorb shocks. Right? Okay. So, so that's basically in general, introduction to the risk management. Let's move on to a little bit in risk in banks and financial institutions, because most of you are working in that environment, because when we talk about business risk in other entities in general, so what are the business risks in general we discuss? What are the business risks in general we discuss for normal business entities? Remember last week? Can someone tell?
Product,
Yeah.
macroeconomic and technological risk.
Sorry? Yeah.
Product, macroeconomic
Yeah.
and technological risk.
Yeah, right. So these are the business risks in general we can think of when you look at a normal business entity. Then they have event risk and non-event risk and also financial risk. Now, when you take a bank or a financial institution, financial risk itself themselves are the business risk, right? So we call credit, liquidity, market, all our financial risks themselves are the business risk of a banking institution, right? So that is the reference. So because their products are different now. When you say credit risk related to their product of lending, right? The market risk related to their products of investments, right? So it's typically in a bank or financial institutions, the financial risk generally we talk are themselves the business risk, in addition to whatever other business risk, arising in the macroeconomic, front, and also technology related risk, which is again part of the operational risk. Okay, so let me move on to systemic risk. Have you heard about systemic risk? So what is systemic risk? It's not systematic risk, systemic risk. Now, systemic risk is the risk of failure of one institution in the industry, threatening the stability of the whole industry. Systemic risk impacts the macroeconomy, resulting in failure of several other institutions and spreading it to whole industry, right? And systemic risk is greater when different institutions within the systems are highly interdependent. These institutions are closely interrelated through their transactions with each other. So when it comes to banks or financial institutions, this is a very important risk, systemic risk. Now, which we don't usually discuss when we discuss the other business entities. Because this is not common thing in other business entities. Why this is specific to the financial institution? The risk is that the problems of one entity could result in failure of another entity. And finally to the entire financial system, right? Okay. Because if you look at financial services industry, these institutions are interdependent, interlinked. No, not like other industries. Now, there could be possible systemic risk, but you don't, usually find systemic risk in other industries because of this linkage. And some factors like high financial gearing, significant mismatch in maturities of assets and liabilities, high depends on public confidence. Uncertainty will lead to loss of confidence. So systemic risk is very prominent in financial services industry, including banks, because of these reasons. What do you mean by high financial gearing? What do you mean by high financial gearing? Can someone explain?
Compared to our bank equity, our borrowings are very high. When it's like normal company, it's other way around. Mostly the equity part is bit higher than the this thing. For the banks, we having borrowings are very higher than our equity.
Okay, so you are right. If you look at a bank or financial institution, the bank's funding, if you look at funding, comes from the borrowings and other creditors like the depositors. Now, if you look at a bank, the major source of funding is depositors' money, and then borrowings from other institutions, and the equity is very low. Okay, so if you look at the gearing or the debt equity in a bank, significantly high compared to a normal business entity. She's right, because normal business entity equity is higher than the borrowing. So that's why even a bank, when a bank grants a loan to another entity, you want to have a lower gearing in that other entity, because you don't want to lend to a company which has a higher gearing, because already a gearing is high. But if you look at your own gearing, it will be significantly high. Okay, because your funding mainly coming from borrowing. Borrowing in the sense I am referring to other parties, others' money. Others' money means what we call depositors' money and the outside borrowings, right? So the banks are the institutions which are highly geared everywhere in the world. Okay, and so your basically business model is such a way you mobilize money from others. Now here we call depositors, and also through other lenders, and engaging granting loans, right? Engaging granting loans to people who need money, right? So you are in a very risky business, because any business entity high gearing means very risky. Anytime you can collapse because your capital is low, right? Now, the second point is significant mismatch in maturities of assets and liabilities. So not only high financial gearing, there is a significant mismatch of maturities of assets and liabilities. This could lead to a particular risk unless you manage carefully, controls carefully. Can someone explain, what is this maturity mismatch of asset and liabilities?
Basically, your long-term borrowing should be matched with your long-term assets, and the short-term borrowings from the short-term.
Yeah, but here's a mismatch. So what do you mean by mismatch in maturities of assets and liabilities?
Most of our deposits are short-term ones, maximum for the 5 years. But our loans are some housing loans are it's 25 years. There's a long-term period of the repayment of the loans. In that, we having a mismatch. That part we have to balance as a banks.
Okay. So if you look at the nature of the banking business, you rely on short-term liabilities, right? Mainly, deposits. Even deposits, I don't think you have a significant portion for 5 years, but most of your deposits in a bank are less than 1 year maturities. Then you have 2 years, 5 years, and so on. But majority of deposits are very short tenor deposits. Okay, shorter tenor deposits. So majority of your liabilities are short term maturity. But if you look at assets, as you said, most of your assets are medium to long term. Maybe short term loans are there, but most are at least beyond 2 years, right? So there's a significant mismatch. So how the risk comes? Because you have to meet your liabilities in very short intervals, but you don't get cash from your maturities of assets to match that liability arising, right? So your 3 months, maybe let's say in your bank A, there's a bank called A. The And for the next 3 months, there are liabilities or deposits money maturing 100 million. So you should be able to pay that 100 million over the next 3 months, right? But let's say you will realize only through your asset maturing is 60 million. So as per today's balance sheet and your forecast, you will receive only 60 million through the maturities of your assets during next 3 months, but you have to meet 100 million of liabilities. So there is a maturity gap of 40 million. So this is the maturity mismatch. This is inherent. You can't avoid it. Remember, if you do the banking business, this is there. So that is the danger. And you can't do banking without this. Okay. So the question is, you have to minimize this and control this. Okay. So that is the important thing. So there, unless you control, there's a greater possibility you will run into a liquidity risk. Because in other words, we call you have a more liquid liabilities than liquid assets in the short run due to maturity of mismatch in maturity of assets and liabilities. Right? So that itself could, unless you manage it, this is there. High financial gearing is there. You can't avoid. If you are doing banking business, this is there. Right? If you do banking business, mismatch is there. I don't see in any bank in Sri Lanka, there is a positive mismatch in the short run. I don't think. I mean, very rare, maybe very rare. So every bank, if you look at short run mismatch, it is always positive. Sometimes significantly positive. Not positive, negative. Mismatch is negative means more liabilities than the asset. Rather, it's very difficult to find a bank with a positive mismatch. Okay. Always, or maybe in 95% cases, it is other way, negative mismatch. So, because of that, so very important to manage the liquidity risk, maturity mismatch to avoid, such a risk event take place. So, which itself could lead to a systemic risk. Okay, right? Then high dependence on public confidence. And uncertainty will lead to loss of confidence. So what is this? High dependence on public confidence, uncertainty will lead to loss of confidence. So these are again two things very important from the perspective of banks and financial institutions. How this can lead to systemic risk. Can someone think about it?
Our financials published in financial years will be watched by the public, and which creates some confidence, which could we are able to canvas, mobilize further deposits. And on the other hand, when the customers request for before maturity, also banks should be able to give realize their funds and able to allow them to take their money back. Otherwise, the public confidence will be lost.
Okay. Okay. If you look at now let's say, and I'll put this way. Now, if you look at banking business or financial institution business, basically governed by the confidence. Because on the trust that bank will pay money at any time the people demand. Okay. I go to the bank and ask for my money. If the bank say no, then that is the first point of losing confidence. So what happens, when you lose the confidence, it will spread fast among the other, because when I won't get my money, I will tell my colleagues also, this happened to me. So this will fast spread, and within a very short period of time, people lose confidence and there's a greater demand for withdrawals, which lead to failure of one institution. And when one institution collapses, generally, people start believing negatively of other institutions as well. You see? So that what happens, maybe failure is going to take place in one bank, but then the depositors of other institutions also think, okay, let's say bank A is going to collapse or maybe collapsed. Then next may be my bank, bank B. So what happened? The bank B depositors also start withdrawing and send bank CD. So that is called the systemic risk. The system will collapse. So this has happened everywhere in the world. The crisis starts from one bank, then spread to rest of the banks and final to the entire financial system. So that is the danger. Because the whole system runs with public confidence. Okay. Trust that the money deposited will be repaid, paid back to the depositor. So that is the confidence, right? So this will not happen, in other industries. Now, for example, let's say due to whatever reason, Bata fails. Let's say Bata is a shoe manufacturer. Whatever internal problem, Bata fails. So since Bata fails, I don't think DSI fails. No problem with the DSI because, okay, the people are not going to do anything with what do you call problem. If Bata fails, DSI would be much happy because there's more business to DSI now. Because Bata customers will move to DSI or maybe Beta or whatever. So it's quite different. But let's say if bank A fails, definitely people will lose confidence and then there could be a possible, problem in another bank or even failure and then through the entire system because of the confidence. So those are the dangers in financial institutions or the banking system, which could lead to systemic risk. Okay. So let's look at how the banks have set up this framework we call integrated risk management framework for banks. So why IRM is necessary, integrated risk management systems is required for banks for measuring and managing risk in an integrated manner to ensure a comprehensive ICAP. Okay, measuring and managing risk in an integrated manner. Now that is integrated manner is same like enterprise-wide risk management. Comprehensive internal capital adequacy assessment program. I think we will discuss ICAP later when we look at the Basel, implementation, right? Then for banks to develop IRM techniques for monitoring and managing their risk and need to ensure adequate capital is held to absorb losses arising from various risk exposures, right? So it is necessary to develop IRM techniques, okay, for monitoring and managing their risk and to ensure adequate capital is held to absorb losses arising from various risks. Well, ultimately, whatever the institution, whether it's a bank or any other institution, important thing is now risks are, impacted on what? Risks are impacted on what in an institution? What is the bottom line of risk? Because if there are risks, means what? End up with losses. Losses means it's part of expenditure. Now, for example, if there are high NPLs and you have to write off or provided for NPL, then it will be part of your expenditure, ultimately leading to impacting your profits or maybe ending up losses. So finally, either profit or losses will hit the capital. Okay, so basically capital is the base which absorb all these shocks arising from risk. Whether it's credit, market, whatever there is, ultimately hit the resultant loss ultimately hit the capital. So all these risks ultimately end up with impact in the capital. So it's very important banks have adequate capital to absorb losses arising from the risk. So the IRM systems does that, to have a separate, techniques to ensure that. So the in IRM framework should cover potential risk, what are the possible risks, possible sources of such risk. Because when you identify the risk and want to manage, you have to identify the sources. Because without sources, you don't know what to do. Right? You don't know what to do. Then mechanism. MIS reporting to identify and monitoring this. So you should have mechanism or the management information systems and reporting to identify and monitor risk. So you have to identify and you have to also monitor. Measures to control and mitigate risk at prudent level. Okay, so you have to have measures to control and mitigate risk at prudent level, right? Officers and committees for control and mitigation of risk. Officers and committees for control and mitigation of risk. So you have to have site frameworks. So that is relevant officers, committees like risk management committees, maybe integrated risk management committees, whatever control it called, credit committee, ALCO, whatever. Then involvement of the board of directors. So these are the previously I discussed the earliest areas that the framework should cover. Then how the directors involved. So the director's responsibility to approve it. So once you set up the IRM framework, directors need to go through and approve it. Then review at least annually, because now when you talk about risks are quite different. Now, if you look at prior to 2020 March or whatever, no one had this anything called COVID or anything where we never thought of. So if anybody go and had a look at your risk frameworks prior to 2020, this area has not been covered. So now, of course, for the last 2 years, almost nearly 2 years, we are running with a risk of, all institution affected with the COVID affected the environment. So this is a new risk game. So definitely when you review, you have to identify the new risk areas or new methodologies. Because certain risks may have gone out from the system, new risk come, or maybe the level of risk also have changed. So the annual review would be, generally good to ensure you are on the right track, right? Assess the integrated risk profile quarterly. So within the year, the framework is reviewed annually, but within the year, every quarter, you must assess the risk profile. Okay, so you know your risk, there's a risk profile. Every quarter, you must assess. Here, the board of directors, okay? So it's the responsibility of board of directors to assess the risk profile quarterly. Overall oversight of the implementation of the IRM. So, and overall oversight. So they are responsible to ensure the IRM framework is implemented in a right way, right? So those are the responsibilities of the directors. So approval, review at least annually, assessing the integrated risk profile quarterly, and overall oversight of the implementation of the IRM framework. Non-compliance. The fitness and propriety of those responsible for lapses, non-compliances will be reassessed. So it's very important. Okay, I mean, just having a framework will not serve the purpose, right? You must ensure its compliance. The people at all levels comply with that. Now, let's say there is a board-approved policy saying there should be two key holders in the world. Okay, so that is in your policy. But whoever, maybe your superintendent or chief cashier has given 2 keys to one person. Both keys to one person. So in your book, it is there saying that the 2 keys should be for this main mode will be handled by 2 people. So in the book, it is there, but practice, we have not done that, right? It's like passwords. Now, how often you all change as password in your critical operations? How often? Anyone from any bank? Sometimes the passwords on critical, databases need to be, changed. That is a control. You don't keep the same password. No, even when we do online banking, banks ask us to change it certain frequent intervals. How often in key areas your banks may be varying depending on the bank's policy. 3 months, 6 months, 1 year.
Yes, 3 months.
3 months, okay. So let's say now your policy in the banks to change it 3 months, but you don't do it. You will not change. So basically, then the framework is there, but you don't follow it. So that is again important, whether you are complying with the risk controls, okay, and who will be responsible, and whether measures should be taken against for people who are not compliant. So that's very important, because no point having it's like what is written in a book. The risk management policy or framework should not be something written in a book. That is something written and must be practiced. You see, written and practiced. And written in the book is not going to serve the purpose, right? So the IRM oversight, the board and senior management. So what is the responsibility to oversight? Remember, I said earlier, the overall oversight is part of the board of directors' involvement, but now that goes beyond the board of directors in certain areas, including senior management. The board is responsible for understanding and managing risk. Remember, we discussed promote a good risk culture with clear policies, procedures, and strong internal control. So you must promote a good risk culture within the entity with clear policies. Must be very clear. Sometimes, in certain policies, there's lack of clarity, doubtful areas, so that no one knows what to do clearly. So it should be very clear, and there should be strong internal controls. So always adopt strong internal controls. Establish risk limits based on risk appetites. Always based on your appetite level of your bank, set limits. This is my, if we look at credit limits now, how these credit limits are applied in your banks. Different banks may be different, but how it like the credit limits applied in your bank. What sort of limits? I am referring to credit.
Approval authority limit.
Sorry?
Approval authority limit.
I couldn't. Your voice is not very clear.
Approval authority limit.
Aggregate borrower limit.
Approval.
Okay, approval.
Authority.
Okay. So how it applies?
Manager and regional manager and assistant regional manager. They have various limits.
Okay. Yeah, your voice is not clear, but I know. So depending on the different disbursement amounts, there are approval limits, like the manager.
Yes.
So manager can approve only up to this limit. Then if it is beyond that limit, that amount, you need to go for the next level. Maybe a senior manager or the other senior level, or then maybe a committee level, credit committee. Okay.
Yes.
And then there may be loans you need to get the board approval, right?
Yes.
Okay. So this is one way of control, risk, risk limit and also the disbursement different limit, and also there may be limits to different sectors. Now, for example, for tourism sector, this is my limit. So from overall exposure, I cannot go beyond this limit. From overall credit, I will only lend 10% to the tourism sector. Okay. And also there may be an internal limit for individual entity in a tourism sector. Okay. So likewise, there may be sector limits. There may be geographical limits based on your appetite. Now let's say Bank A have an internal limit of 15% of your total loan is only for the tourism. But it is not the same for Bank B, because Bank B say, okay, I am willing to lend up to 25%. So say Bank A is 15, Bank B is 25. Why? Because the risk appetite is different. So based on your risk appetite, establish the limit, right? Then of course there may be, other limits in the treasury operations, the intraday dealer limits, FX limits, stop loss limits. So there are so many limits relevant to the different risk elements and also appetite, based on appetite. Oversee the implementation of IRM by senior management. So it is part of the board responsibility to oversee the implementation of the IRM by senior management. Then usually we have an integrated risk management committee in a bank. So that is the key subcommittee, I think, within the bank, that who is responsible for the overall risk management framework. Overall risk management should be assigned to the board subcommittee on IRM. So because now, even though board is ultimately responsible to the oversight, but board of directors not directly engage in day-to-day operations. Usually, and also they only take broader policy decision. But there should be a separate committee like IRMC to have a, look at all these risks in a much broader way on a day-to-day basis, right? Then internal audit, review the IRM process and ongoing work. So there is an independent review by the IRM. By the internal audit of the IRM, right? So they are independent. So they look at independently about the IRM process. So what are the IRM priority? Architecture of IRM function should be bank specific and depends on the size, complexity of functions, operating environment and technical aspects. So this is what I said. I mean, you can look at another bank and see whether your one is strong, weak, or what. Because that is a function specific to the bank and depending on the size. I mean, you can't expect a system that is followed by a very large bank having higher risk to a smaller bank like you. Okay, so depends on the size, complexity of functions. So your functions may be, now if you look at a larger bank, they have a broader level of functions compared to you. Because they have so many branches, number of staff, number of business areas, markets are different. Now, let's say if you take a bank operating not only in that country, now let's say HSBC UK. Now, HSBC UK is a bank operating all over the world. Okay, so their structure, size, complexity is different. But if you take another bank in UK, which is only in UK, it's quite different. So similarly, if you look at Bank of Ceylon, quite different to maybe a Union Bank, right? So remember, your architecture should suit your requirement. You can't compare with another person and set up the framework. So that is the danger, because many people going to follow the other bank. You may get an idea if other banks' operation size, everything is similar to you, but not if not similar, you should not follow. All material risk and measurement tools should be incorporated. So all material risk and measurement tools should be incorporated into the risk management framework. stress testing and scenario analysis should be included. So another two important areas, probably we will look at later on this particular course when we talk about the Basel applications, stress testing and scenario analysis. Okay, so how different risk event can end up if they are going to happen. So that is called the stress testing. Arbitrary, looking at arbitrary event and do a, assessment on impact. For example, if I take an example of current scenario, now I think all of your banks have granted moratorium for some particular sectors affected by the COVID, right? I think all of your banks have granted certain moratoriums. So that basically, assuming they will be paid, you have extended the repayment period and allowed a further grace period, interest waivers and so on. Now, stress testing is something you assume, let's say you have a 10 billion portfolio granted under moratorium. You assume that, let's say 50% will not pay. You assume that tourism sector will not revive soon, and you will assume 50% will not pay. So then do a study. If 50% is not going to pay, this is something assumption. And this 50% not paying is something that you going to happen, but you assume if 50% is not going to pay, what is my situation? Right? Then you know the bottom line. How much your losses would be, how much your capital impact would be, and so on. So that is called the stress testing or the scenario. So you consider some stress events possible to happen and do an impact study now. So that the important thing of stress testing is based on the probabilities and possibilities, you can ready now. You see? You can ready because you can't take decision if it happens. It's like when you drive on a usually when you drive you want to go long trip. Now Sri Lanka, it's not you don't find lengthy trips, but if you go to other country, you want to travel about 500 kilometers. So basically, these people look at many events. Okay, what is the situation? What is the weather condition, road condition, traffic conditions? So they pre-plan. Okay, so let's say if there is flooding on that route, what would be the impact and what are the measures I would? So they can't take. You see, so that's sort of a stress testing. You think something going to happen. If it happens, then what should be the measure? What should be the impact and what is the measure you suggest? It is some advanced preparation. Advanced preparation. Risk aggregation and diversification. Now, once you identify the risk at each business unit or maybe individual business lines, then aggregate risk and see what is the overall impact. Now, this is important. Why we need to aggregate? Okay. So when you look at overall business risk, overall risk from the entity perspective, rather than the individual business lines perspective, there may be risk within individual lines which you can easily control, or may be controlled by another event of another business entity, business unit. So be mindful of risk contagions. Okay, let's say it's like taking drugs. Drugs means medicine. Now you are let's say patient of blood pressure. Then there are medicines available to control blood pressure. But usually doctors ask several questions before giving the drug. You have this problem, that problem. Let's say you have a kidney problem. So particular drug which you are going to use for the blood pressure may not be good for the kidney. If you are a kidney patient. You see, that's a contagion effect. So you can minimize the risk of blood pressure, but will end up with risk of causing damage to your kidneys. You see. So when you control one risk event, the risk, methodology will impact result in another risk event. You end up with creating another problem. By solving one problem, ended up with creating another problem. So you have to be very careful. So risk contagions. You have to identify that. The document decisions and assumptions used in risk aggregation. So it's very important you identify individual risk arising from each business operation or unit, then aggregate looking at risk contagions. And other thing also happen. Sometimes, there is a risk from one entity, then you have a control measure, then there's a risk arising from another entity, you need to have another control measures. But if you can combine those two, ultimately risk will be zero. So that means risk arising from one business unit may offset the risk arising from other business unit. This could be possible in a large business organization. So that you need to control it because one offset the other. Right? One offset the other. That's like, you are taking a collateral. Even though there's a failure of, that entity and cannot recover, you have a, collateral to recover the loss. Okay. So similarly, one business unit ended up with a particular risk, but which could ended up with a risk event of another business unit. Manage. So that's why the aggregation will help to identify the important risks that you need to cover up, and also it's important to document all those things. Any questions so far? Anything you need to clarify?
Yes, sir. To have an integrated risk management system in a bank, is it compulsory or legally compulsory, or is it on prudent basis that banks do?
Last part I couldn't hear you.
To have an integrated risk management system in a bank,
Yeah.
is it legally compulsory, or on a prudent basis banks do that?
Oh, in fact, if you look at there is a direction issued by the central bank with respect to the, risk management. So there are certain things compulsory, right? The regulator itself has, like now there's a corporate governance direction. So there is an integrated risk management guideline direction. I can't remember the number. So you must comply whatever the requirements as per that direction, like IRM, then you have to meet periodically, you have to set limits, certain things. There are certain things specified in the direction. Okay, those are compulsory. But in addition, you may have your own independent, that's a minimum. That's a minimum. But you can have your own independent other measures to mitigate your risk. So there may be things, required by the regulator for you all to do, but there may be things you voluntarily have in place in your bank to manage the risk, right? So please refer to risk management direction of central bank, maybe part of corporate governance direction, maybe where they specify certain things you must do. You must do. Okay.
Right. Thank you.
Any other questions? Of course, if you go to the central bank website or the bank supervision website, definitely there may be a link to all these directions. I am specifying broad things here because I am not trying to focus on all regulatory aspects in this course, because this more practical I'm going to look for the practical aspects only. Okay, so let's move on to the credit risk management. Now we earlier we discussed in general, overall in general, what things you should look at when you set up the risk framework, prerequisite, oversight, and the priorities, right? And the aggregation and diversification. So let's move on to the credit risk per se, and what things we should set up. Now credit risk, now oversight, we need to ensure board-approved credit risk strategy and risk policies, approved loan products and collaterals, target market and sectors. So very important areas that should be covered in the oversight. So what should be the board-approved credit risk strategy and policies? Board-approved, remember? It should be approved by the board. And loan products and collaterals. So what are the approved loan products and collaterals? So if you can't go beyond those approved loan products and collaterals, you can't go beyond. Now, let's say somebody wants to obtain a loan, then depending on the limit, you already have a framework in place. Okay, whenever you grant a loan to this sort of a customer, this risk customer, you must obtain this particular collateral. So you can't go beyond that. Let's say the collateral offered by the customer is different, you can't. Because that is the approved loan products and collaterals. But of course, at a review, you can include or exclude collaterals when you review. Now, let's say I said policies need to be reviewed by the board at least annually, right? Then target markets and sectors. Okay, so there may be target markets, and sectors. Now, not all banks give loans to everybody, you see. Now, and also maybe what you call I will come to that later, the limits. So different sectors. Now, certain banks may not give loan to certain sectors at all. So that is part of their policy, nothing wrong. You can't force, right? So you have target markets, but sometimes there may be regulatory requirement stating certain limits to certain sectors. Now, for example, I think some time back, the regulatory requirement imposed on agriculture sector. I think that is still there. Agriculture sector, I think some of you can remember. There's a mandatory lending, right? So you must lend, I think this was somewhere around 2009-10, I can't remember. You can double check. There's an agriculture lending mandatory requirement of 10% of your total loan portfolio. Double check, I'm not sure whether it's even there now. So that is something the regulatory imposed, sector and sector limit. So that's a target sector you need. Anyway, you have to comply, whether you like or not. So there may be cases like that. But other than that, you are free to decide on markets and sectors, but that should be part of your oversight. Then the risk management, okay, the preferred level of diversification and concentration. Now, these are the area where risk controls are brought in, okay. So what is your diversification and concentration? Now, probably like sector limits, the markets, okay, markets. Now, I mean, in Sri Lanka, most of your banks are limited to Sri Lanka, except few banks who have operation out. If you look at the Bank of Ceylon, they have few overseas branches. Maybe, I don't know whether commercial bank has some overseas branches. I don't know, maybe in Bangladesh.
Yes,
so there may, huh?
Commercial banks have overseas branches.
Okay. So only few, yeah, okay, right. But generally very limited operation. But if you take an international bank like Citibank, Deutsche Bank, then HSBC, Standard Chartered, you see, they have, expanded operation all over the world. Okay. So that's part of their diversification, right? Because they just don't want to, now if you look at Citibank is a US incorporated bank, they don't want to be part of US only. So they want to diversify their business operations to other, regions, maybe Europe, maybe Asia, and so on. So that is part of their diversification. You see, even some problems in US markets, still they are better off in other markets, right? You see. And the concentration. Concentration is the opposite of diversification. The concentration is you concentrate into few areas. Diversification is you expand into many areas. So it's part of your risk management, your prepared level, no harm. Okay. Then prudential limits like sector-wise limit, single borrower limit, other ratios, LTVs, Now, certain LTVs are regulatory, certain are your own LTV. Now, LTVs, loan to value ratios. Now, let's say a classic example of loan to value ratio you apply is in which area?
Leases.
Vehicles. Yeah. Vehicles usually have a typical LTV, but vehicles, there are certain regulatory imposed limits also. But in addition, you can have even what you call housing mortgages, property mortgages. So from the market value, you will go up to maximum 80%, 70%. So these are prudential limits, right? Pawning. Pawning, again, you have some limits, based on the pawning, what you call gold price or whatever. And also sectors, for particular sectors, let's say I will only lend 25% to tourism. I will only lend 15% to, maybe garments or maybe fisheries, likewise, depending on the sectors and the risk, you may have your own limits. Risk acceptance criteria and credit approval authority. Okay. So like previously said, now what is the criteria for acceptance? What is the approval authority now? Let's say any amount of loan cannot be approved by the manager. Even a branch manager can go up to only a particular limit. Beyond that, he need to process and forward into the next high level, higher authority level. So there may be acceptance criteria and approval authority. Portfolio management and recovery management. Now, portfolio management is now overall management of the credit portfolio. Now, even though there are individual units responsible for certain types of products, and maybe at maybe branch level operations related to credit, but then portfolio management, overall credit. So overall credit department, in the bank, there may be separate credit management department, credit risk management unit. So that may need to look at overall risk management and recovery. Now, how do you recover? What is the process? Okay, what controls in place? The credit risk management practices, single borrower review, annual customer and limit review, customer visits. Now, again, important to embed the risk management practices in place. Okay, so annual reviews is very important, Once you grant a loan, to review the customers annually so that in advance possible problems the customer face or the risk arising from inability to repay the loan. Then limit review. Again, maybe you need to review the limits. Those may not be static. Sometimes certain limits you need to reduce, certain limits you need to enhance. The customer visits, okay, those are also should be embedded into your risk management framework. Internal risk rating grading system for pricing the risk. This is again important element. How do you price the risk when it comes to credit? Okay, how do you price the loan? You may not charge each and every customer or each and every loan given to particular sector at the same rate. Okay, so you may have your own internal risk rating or grading system, which categorize, risks into, customers into different risk categories. Okay, 1, 2, 3, 4, 4, 5. Okay, so every bank may be having internal or grading system, or maybe sometimes you rely on external rating provided by the rating agencies for creditworthiness of customers. But always many banks, I think have their internal risk rating system or grading system for better pricing the risk. So the ultimate price of a price, in the sense, what do you mean by price here? The interest rate charged for the customer depend on the risk grading system, right? Early problem recognition and watch list. So there must be a mechanism to identify problems early. When you see your NPLs gradually start picking up, or maybe customers not paying, on time. So probably then you have to have some early warning system, recognition system, and have a watch list. Okay, so definitely those watch lists are important. Watch lists are important. So there you can take measures before a customer getting into further trouble or becoming NPL. Then classification of problem exposures and remedial actions, right? How to classify problem loans and what remedial action you should take. Then MIS on reporting credit risk data. Okay, so in order to do all those things, it is very important you have proper MIS in place. Okay, so management information. Earlier, I think I explained the importance of MIS. Here, the absence of proper MIS has itself led to problems. Okay, so it is very important have a proper MIS. Now here we talk about credit risk, so relevant to credit risk. Okay, so MIS reporting and credit risk data, so that the management and the board can take informed decisions. Okay, so without good MIS reporting of credit data will have some problems. Okay. Then we move on to the market risk management, right? What is market risk management? Again, if you look at the principles are same, but the techniques may be different little. Now, again, if you look at the oversight function, you should have board approved market risk strategy and market risk policies. Now, like what we look for credit risk, then how do you manage market risk? What is your strategy? So what is your risk policy with respect to managing market risk? Then again, for market risk, the approved products and counterparties, interest rate related FX and equities. Now, when you talk about market risk, we talk about the 4 key elements, the FX, interest rate, equity, and the commodities. So they are, if it's relevant to all those related instruments, you have to have approved products and counterparties. Even when you deal with when you engage in dealing, for example, FX, you may not have everybody as counterparty. So you may have limited counterparties, right? You may not do deals with all products. For example, especially derivative products. So you have approved products, right? Then you have ALCO. Now this is again very important. Now asset and liability committee, important part of market risk management, especially when you talk about treasury operations. Then risk management function, the treasury function and control. So what are the risk management relevant to the treasury function, and what controls you should have in place. The prudential limits, like credit limits we discussed, single borrow limit, sector-wise ratios, LTV. Here we have net open positions, NOP, gap limits, the different gaps for maybe maturities of interest rate related assets and liabilities, what you call repricing gaps, the treasury operation limits, within the treasury operations, different limits. For maybe dealers, maybe day limits, maybe counterparty limits, and so on. Then value at risk limits. It's again important. If you follow the value at risk models in your banks, probably you need to maintain certain limits. Your maximum losses. We will discuss value at risk when we look at the market risk in detail. So those limits could be in place. Okay, so that means no one can do business related to market risk, or maybe within those limits. Then FX risk management, especially FX risk management, what are the tools you have in place, or policies, procedures must be laid down under the IRM framework. Then foreign currency liquidity risk management. Now, just not the FX risk per se, but the foreign currency liquidity risk management. I think this is a very important topic for the day, I think if you look at today, I think all banks have tight foreign currency liquidity. So this is an important element. Usually we talk about domestic liquidity, but now in certain times, FX risk, foreign currency liquidity is an important element. I think almost every bank today in present environment have a very tight, situation in terms of foreign currency liquidity. So it's a very important area and should be part of your risk management framework. Now, because certain things you don't foresee in certain environments, you see, because each time period environment different, you see, each time period. So that's why now in I think today's world we see many things, but if around maybe 2015, 16, we didn't see these risks, but now today we see certain risks which were not there earlier, right? So let's move on to the operational risk management. Again, oversight. Again, like two other risks, board-approved operations risk strategy and the policies must be in place. So what is your operational risk strategy and the policies? And risk management. Now it's very important. So I think all of your banks have business continuity and disaster recovery plans. How many of your banks have this BCP and DRP in place? Anyone? Any ideas? Can you all hear me?
Yes, sir.
Okay. Okay. So what are the, how many of your bank tested BCPs? That's very important. Menaka, please tell me if there is problem. Huh?
Okay, sir. Okay.
Yeah, because I can't see suddenly.
Yes, sir. Yes. Okay, sir. Okay.
Okay. So undertake compliance review. So what is important is, rather than having a BCP or DRP in place, you must test them regular basis because the system is working. Because even though if you have a BCP in place, suddenly you want to implement in a disaster system may not work. Then no point. So BCP testing, I think even in central bank, our colleagues in the relevant department do BCP testing. Even we have like more security, fire, risk testing every year. Of course, last year maybe not possible, but every year they do a fire testing, maybe every year once or twice. So to educate people, know what is happening, how to recover if such event take place. So these are things you must do. No point having in the book. Just having in the book we have a BCP, DRP in place won't do, because you really don't know whether now say probably you may have a backup site. So suddenly event take place. You have never done BCP. Suddenly you go to the site cables are not working. Site doesn't start operating. You can even switch on the systems. There's no interconnectivity. So how do you run? But in the book you have a BCP. Very nice, but no point. So remember, practicing them also important as part of your operational risk management framework. Undertake compliance reviews by the internal audit and the risk management department separately. Okay, undertake compliance reviews by the internal audit and the risk management department separately. Insurance covers now. So definitely when there are external risks, you can cover insurance. Now, in particular, the couple of key operational risk areas you take insurance. Can you give example? Operation risk related operations you generally cover, take risk. Can you give a classic example? I am not referring to like
cash operations.
Exactly, cash operation. Now that is an area which have a significant operational risk internally and externally. While cash in transit, there could be external robberies or fraud. Okay, cash. So basically, you take cash in transit. Even the counter, sometimes counter people are covered with cash in shortages shortages risk. You see. So insurance covers to externalize the risk policies on out. Now, this is again important area, outsourcing. Now, today's context, many banks outsource their operations. They don't conduct operations inside due to the maybe less in size or maybe the efficiency. So no point in having a big staff. So now certain critical operations, other than which is not permitted. Now maybe the central bank certain directions has prevented you from outsourcing certain things, certain functions, but any other function you can outsource. So it's very important the policies, because there may be significant risk arising from outsourcing arrangement. So how do you cover up those? So what are the responsibilities between the bank and the outsourcing part? Especially now, I think many banks conduct, their IT backups, IT systems through the outsource companies, you see. So there may be sometime your important information may be, privy to them. How do you ensure no leakage of information? How do you ensure that your systems will not get corrupt or maybe, hacked, okay, due to those lack of controls by other parts. So this is very important as part of your risk management, operation risk management policy. Okay, so let's stop for almost 10:53. I didn't see the time. So let's stop for a tea break for about 15 minutes and then we'll continue after that. So we can discuss any questions before we start after the break. Maybe probably around 10:10 we can meet. Sorry, 11:10. Okay, so we will meet around 11:10. So let's move on to the liquid risk management part. So again, like in all other risks, the oversight should basically cover board-approved liquidity strategy and policies and the ALCO function, right? So it's very important, like other risks, is what is the strategy the bank going to follow in respect to the risk, liquidity risk, and also the liquidity risk policies. In risk management part, liquidity measurement is a difficult task and can be measured through stock or flow approaches. As you know, we will probably discuss when we do the liquidity risk asset management. There are two approaches which we commonly use to manage liquidity risk: the stock or flow approaches. Sometimes some banks follow one approach. Sometimes some banks follow both approaches simultaneously. So that should be part of your liquidity risk management framework. The stock approach measure the stock of liquid assets in the balance sheet in terms of key prudential indicators such as net loans to advances, net loans to total assets, loans to deposits, liquid assets to short-term liabilities, SLAR, commitment to total loans. So there are key prudential ratios or benchmarks the bank would set in the policy framework, so that bank would try to see whether bank's relevant actual ratios are within those set limits. So that is the stock approach. Then the flow approach basically measures the required liquid assets to cover the net cash outflow. So basically this is based on the flow, that is cash inflow and outflow basis, whether the net realizable liquid assets are adequate to cover the net cash outflows in the shorter front. Now again, two important elements are the LCR. Now, of course, we have NSFR and also the maturity gap analysis, right? So where the cash inflows and outflows are the major indicators of liquidity. Then bank should evaluate liquidity profile under different stress situations: the normal situation, bank-specific crisis, and market crisis. Now, as I mentioned at the beginning of the lectures last time, now, I mean, for a bank, all these risks are very important, but on top of each risk, liquidity risk appears to be most important, because the liquidity is immediate ability to meet the obligations from liabilities and asset side, more importantly liability side. So it's very important, so that there are stress testing done, that the ability to ensure ability of the bank to maintain liquidity under normal circumstances, bank specific crisis and the market crisis, because in a difficult situation, stress situation, very difficult to manage liquidity often than any other risk. Then the bank should have liquidity contingency plan. So if there is sudden liquidity risk arise, how to meet liquidity? The contingency plans basically with other parties or maybe other alternatives which are practical to meet the emergency liquidity. Liquidity from CBSL as the lender of last resort should not be recommended for contingency plan. Now, the lender of last resort should not be part of contingency plan, because that may be the last option any bank would have if there is a liquidity situation. The availability of backup liquidity, support form of committed credit lines, reciprocal arrangements, swaps arrangements, liquidity support from other external sources. Now, not like other risks, during a liquidity crisis, you don't have much time to react. You don't have much time to look for solutions, because liquidity is immediate. So you can't wait even a couple of minutes. So that you can't think of plans at that moment. So you must have these contingency arrangements in place to implement. Now, sometimes committed credit lines. You have established emergency funding credit lines with certain other counterparties, so that suddenly, you can, draw from those lines, right? Then reciprocal arrangement between, your friend, because between two parties, there could have been already set agreement. Okay, if you have problem, I will support you. If you have if I have problem, you have to support me. So there may be contractual arrangement between the parties, swaps arrangement. Sudden, swaps you can do, engage now to, mitigate the liquidity risk. Then probably any other sources, external sources, other than standard banking credit lines, probably to meet the liquidity. So those are very important, because not like other risks, we don't have much time, space to meet liquidity requirements at a shorter space. The interest rate risk management, again the oversight. Again, there should be a board-approved interest rate risk policies and procedures. Then classification of security, it's again important, classification of securities as trading, AFS and HTM, because you cannot, you can't wait without categorizing. So this is something important from what you call the market risk point of view, and also the accounting standards point of view. Remember, all banks are now following the IFRS 9, where IFRS 9 says, you need to fair value, whatever the relevant, assets. So classified in terms of trading purpose, what you call available for sale, AFS purposes, and held to maturity purposes. So that's very important. From a market risk perspective, the interest rate risk, because the risk arises if some instrument is in the trading portfolio, not otherwise. Now, if you look at a treasury bill, treasury bill or treasury bond is interest rate related instrument. As far as you hold it till maturity, you don't have any interest related risk, because the interest rate changes will not affect your market value. Because at the end of the maturity, you will get your face value. So there is no market risk. It's only the banking book risk of recoverability, the repricing and the what you call refinancing and the investment risk that arises. Then risk management, again, like the other market risk elements. Prudential limits such as value at risk limit, stop loss limit, maximum maturity limit, holding period limit, duration. Now, we will discuss duration in detail when we come to the market risk part. So what is this duration? So that's again important risk management tool, especially the large funds. If you are a fund manager in your organization, probably this is an important element. How do you hedge your risk using the duration technology? That's again important concept. So we will look at duration in detail when we discuss the interest rate risk management. Then position limit. Okay, different positions limits, rate sensitive gap limits. That again relevant to the repricing gaps. Again, we will discuss during our market risk management module. So, but ultimately what is important is to have the prudential limits in place to manage the interest rate risk. Then impact on net interest income or net interest margin on banks due to the movement of interest rates. So there may be policies to measure the impact on net interest income or net interest margin of banks due to the movement of interest rate. Okay. So let me a little bit elaborate stress testing, which I briefly explained earlier. Now, stress testing also is important part of IRM framework. So board should put in place a stress testing framework with approved stress testing policy and procedures. So there should be a board approved policy stating the framework for stress testing, right? And also how you do it, procedures. So board to review the results of stress test regularly, including major assumptions. Now the stress testing is futuristic, having a futuristic view on certain things happening. And if happens, what would be the impact? It doesn't mean the assumptions you make will materialize. Now, for example, you may do a stress testing assuming 50% of moratorium loans will go bad. No, that doesn't mean that 50% will go bad. So that's based on that assumption, you do a stress testing to see the impact on your loan portfolio. How much your NPL will rise, how much your write-offs will be, what is the impact on your profitability. So that is a stress testing done to assess possible impact if that happens. So why we do that is now we will be ready now itself if there is a chance of that is happening. So once you decide the stress testing impact, you have to see the possibilities of that happening. Possibilities of that happening, and if it is significant possibility, then of course you have to have adopt appropriate measures, right? Then you have to regularly see the results review. You can't just sit and wait because policy is there. You have to do the stress test regularly and see the results and take appropriate measures. The policy should include identified principal risk factors which affect the bank's portfolio and required to be stressed. So you are not required to do stress testing for each and every thing, So you must identify particular risk portfolios or particular risk events that could end up with a disaster to the bank. You see, if that happens. So, and those events could only be stressed, So then there should be procedure for setting the stress tolerance limit, you see. So there should be stress tolerance limit, necessary remedial trigger actions. Now, so tolerance limit, within which limit you can bear, even if that event happens, you are not worried. So that's a bearable limit. Then remedial trigger actions. As I mentioned, what actions you propose in a case where such event take place. The delegation of authority to execute remedial trigger actions. Then again, you must assign people to take all those remedial trigger actions, right? Frequency of stress testing depends on the bank's size and the need. I mean, certain maybe actions you may need to do daily stress testing. If there are significant fluctuations, then weekly, monthly, quarterly. So that depends. And there is no right size for each and every bank. That depends on the risk event that you are going to measure through the stress testing and size of the impact and size of the bank. And stress testing could be divided into minor, moderate, and severe. Like for minor, if 20% of tourist loan portfolio go bad, what would be my impact? If 50% go bad, what would be my impact? If 80% go bad, what would be my impact? So on. Or maybe if you take exchange rate, if the rupee depreciate by 20%, how much impact on my foreign exchange? If the rupee depreciated by maybe 50%, what would be 80%? So it's like minor, moderate, severe, to look at the impact. Similar for interest rates. Let's say interest rate rise by 2%, what would be the scenario? It will rise by 5%, what would be the scenario, and so on. And different, levels you can classify as minor, moderate, and significant. So based on that, you come up with the, result or the outcome of a particular event. If it happens, then you can get ready depending on the possibility of that happening. Then disclosure requirements, again, important tool. When we talk about risk management, you have to disclose your risk management principles, board approved disclosure policy, internal controls on disclosure process, balance between quantitative and qualitative disclosure. So what need to be disclosed? Quantitative, like risk indicators, liquidity, capital adequacy, and NPLs and so on. And qualitative, your qualitative aspects of procedures, processes in place, measures taken, the stress testing technology, and so on. Okay. Then, so what are the typical disclosure requirements? One could think of strategies and policies. What are the risk management strategies and policies you adopt in your bank? Structure of the risk management function, how this risk management function is structured within the bank, the scope and nature of risk mitigating. Now, what policies you adopt for hedging or mitigating risk, and strategies and process for monitoring risk. So what strategies or what procedures you follow in monitoring risk. So those are part of, I think, disclosure requirement. Okay. So that's basically the introductory, part of this course, which gives a general overview of the risk, how do you manage risk, and what is enterprise risk management process, then governance structures, attitudes, and how the risk management focus or IRM program in a bank is going to be designed or captured. Okay. Any questions? Can you see this presentation, new one?
Yes, we can see it.
Okay. Right. Before we move on to the next area, Anything else? Any clarification you need?
Yes, Mr. Karunatha, you use the word appetite and attitude. So, is there any differences or similarities between the words, or just the same thing, appetite and attitude?
Okay, it's more or less similar, you know. Appetite to attitude, more or less similar. How do you look the risk from your perspective? Appetite is, you know, how much risk would you like to take? You know, my risk appetite. You know, like your appetite. You know, my appetite for, you know, maybe you know, certain food. You know, so it's your appetite. The risk tolerance. Appetite measures the how much risk I would like to take. Okay, appetite in terms of different risk event. Okay, now for example, if you want to grant a loan, there may be a particular risk appetite. Now from the sector perspective, the bank say, okay, my risk appetite towards you know, granting a loan to tourism sector may be around this much. I should not go beyond that. Okay. The risk attitude, again, more or less similar. Now, attitude means how do you look at risk from different perspectives? You know, whether you are more, in general, you are a risk averse, you know, risk averse, you know. In general, would you like to take higher risk, like a risk lover, risk seeker? Or whether you are risk neutral, you know, in general, what is your attitude to look at different risks? You see, different risks, you know, differently. You know, that's a general thing, applies to the entire, band. Your overall risk attitude towards risk in general, right? Risk neutral, risk lover, risk averse. It's a general thing. Okay. Risk appetite is little bit, you know, micro, how much you consider my appetite toward a particular risk. So let's say generally, you know, you are a risk averse person, but within that risk averse, there may be a particular risk appetite to certain sectors. You see, both are similar, like way of looking at risk, but in general and specific, like I think. You see, within the risk neutral culture, you follow different risk appetite to different risks. You know.
Thank you.
Any more questions? Okay, so let's move on to the new area. The first, you know, the specific modules. The first part I would do is market risk measurement and management. Probably Mr. Fernando will touch on credit risk and operational risk. So I would cover market risk measurement and management, liquidity and equity risk part, which are part of market risk and liquidity risk. So the first module we're going to cover today, market risk measurement and management, and which will continue for few more lectures. So try to participate in all 3 lectures, all relevant lectures in the future, so that there won't be any, you know, lack of clarity or loss of connection between the lectures. So let me go to the market risk. I think most all of you know, as bankers, the potential market risk means the potential risk that value earnings of a financial institutions may decline due to exposure to systematic risk factors. Now remember systematic risk factors. Earlier we looked at, when we looked at the banking risk, similar word, what is that?
Systemic risk.
Systemic risk. Now here systematic risk factors. So don't mix up. Even some exams I have seen the right word is not used. Now systemic risk is, it's a risk that could have a contagion effect on a particular sector due to failure of one risk of failure of one entity in the particular sector. So that is systemic risk. Now, usually banking industry could have a systemic risk due to failure of one entity. But systematic risk is market risk that could arise due to the exposure to systematic risk factors. Now, what are the systematic risk factors? Are the factors that have possible changes due to whatever forces in the market, which as an entity you don't have any control. Now, the 4 key factors we look at under market risk for bank is interest rate risk, foreign exchange risk, equities risk, and the commodities risk. But from a Sri Lankan bank's perspective, in particular, the first 2, interest rate risk and the foreign exchange risk, and little maybe equities risk, but hardly, hardly any commodities risk. But from international bank's perspective, all these 4, count for market risk. Okay, why do we say market risk? The banker do not have any control on this. Okay, because you don't have any control. Because these changes, fluctuation on these elements come in the market events. You cannot control. Now, for example, take a classic example of simple example of commodity risk related to the gold. Now, in international banks, this is a commodity which is used for trading purpose. They buy and sell gold, many international banks. So they are subject to commodity risk. Now, they don't have any control on the gold price. You see? Let's say Citibank, if the Citibank is doing gold trading, Citibank don't have any control on the gold prices. They can control risk arising from gold price fluctuations. If they have gold portfolio, then probably they can have a methodology to mitigate risk when the gold prices goes ups and down. But they don't have control over the gold prices. Similarly, your bank don't have control over the market interest rate. Market interest rate goes ups and down because you don't have any control depending on the several macroeconomic and other related factors. Because when the market forces, and demand and supply decide, exchange rate differs daily. So you don't have any control. You don't have control on the equities prices of your investment. You don't have any controls. Depending on the market demand and supply, there may be fluctuation on the equity prices, so which in turn affect your portfolio. So that's why we are called, these are market risk factors or systematic risk factors, right? Now, market risk is defined as the risk of losses in on and off balance sheet positions arising from the movements in market prices. So it is a risk in on and off balance sheet positions arising from movements in the market prices. The risks subject to this requirement are, when we talk about market risk, we don't consider all these related risks in your bank: interest rate, foreign exchange, equity, and commodity risk, only if they are like this. Now, what are the conditions? The risks subject to this requirement are the risk pertaining to interest rate related instruments in equities, interest related instruments, and equities in the trading book. So if there are interest rate related instruments in the trading book and equities in the trading book, then there's a market risk element. So let's say if the interest rate related instruments are not in the trading book, then market risk will not apply, right? If there are equities not in the trading book, then market risk will apply. So if the interest rate related instruments are and equities are in the trading book, then market risk apply, right? Now, classic example. Can you give a classic example of interest rate related instrument not in the trading book, but interest rate related? Especially in Sri Lankan context. Maybe in certain countries may be different. Can you give the classic example of an interest rate related instrument not related to investment? I know you will tell enough on investment side, which is not subject to the market risk. Can someone tell?
Statutory reserve rate?
I'm asking instrument, in particular instrument. Your product.
Share investment?
Huh?
Investment in shares?
No, I'm about an interest rate related instrument. Shares is not an interest rate related instrument, no.
Okay.
Interest rate related instrument in your bank, which is not be subject to the market risk part.
Treasury bonds?
Treasury bond again could be, either way. It could be just because of a treasury bond, it will not be, it could be either trading book or not in the market risk.
Treasury bills. We resell it.
Treasury bills. Treasury bills could be depending on your whether you use it for trading or whether you hold it till maturity. It could differ. I am asking particular instrument which is directly not a part of interest rate related, but not a part of trading book.
Loans?
Huh?
Loans?
Sorry?
Loans?
Loans, exactly. Loans. Loans are interest rate related instrument, but not a part of market risk trading book, especially in Sri Lankan context. But there may be certain other countries, there are loan sale products, so it is part of maybe trading book. But in Sri Lanka, we don't do any loan trading, right? It's not part of the trading book, but interest rate related, you see. So no, what I want to emphasize is interest rate related, even though interest rate related instrument in your bank, not all are subject to market risk. Only if it is in the trading book, it is part of the market risk. Now, let me come back to the bonds you mentioned. Now, bonds could be either part of market risk or not, depending on whether you are holding it for trading purpose or not. If you are holding it for trading purpose, yes, that is part of your market risk. If you are not holding it for trading purpose and if you want to hold it for maturity, that is not part of market risk. It could be either way. Okay, so important thing is the risk pertaining to interest rate related instrument and equities in the trading book. It's only if it is in the trading book, you are subject to market risk. So that is important. So loans are a classic example. Foreign exchange risk and commodities risk throughout the bank. But this is different when it comes to foreign exchange and commodities. Now you don't separate trading or banking book. Foreign exchange related any instrument in your book is subject to market risk. Commodity you hold in your bank, any commodity will be subject to the market risk. So that is market. This is very essential because when we look at the non-trading book, we only look at the repricing risk, reinvestment risk, not the trading risk. Right? Okay. So let's look at little bit theory on the interest rate, because now first part of our market risk is the interest rate risk management, which I will cover, and of course foreign exchange risk will be covered by another resource person, probably maybe Mr. Jaivir, I think. So let me cover the interest rate risk of the market risk. So let's look at, I think all of you know basics, these basics, but to recap, what is interest and interest rate? Now, according to economic theory, interest is the price of money over time and comprises inflation, cost of deferred consumption, and the risk. Okay. So it is a price for the money. Okay. Interest rate is the price of a money in lending and borrowing, isn't it? So when someone lend, when I buy a TV, I pay a price. So when I borrow from your bank, I have to pay you a price for borrowing. That is interest rate. So which is comprised of some elements: inflation, cost of deferred consumption, and the risk. Right? So when you grant a loan, you factor inflation to that. And opportunity cost of using it, then you factor that. For now, you tie up a 2-year loan for a 2-year period. There's a cost of deferred consumption. So that cost. And the risk of granting the loan. Okay, how much risk? So the risk factor varies. The inflation may be common to anybody. Cost of deferred consumption may be common, but risk may be vary. So that's why you have different interest rates for different customers, different sectors. Now, rate of interest is the scale of the price of money over time and quoted as a percentage. As we know, we quote interest rate as a percentage. The rate of interest or price paid by a borrower of funds to a lender of funds. Now, importantly, when we talk about interest rate, we have to look for the term structure. What is the term structure? The variation in yield for related instruments that differ in maturity is known as the term structure of interest rate. Right? On a given day, let's say today, at a specific point in time, the relationship between rate on short and long-term securities is represented by a graph. Rate on vertical and rate on vertical side and the time on horizontal axis, known as a yield curve. How many of you have seen a yield curve or known about yield curve? So from a banker's perspective, the term structure or the yield curve is a very important element. How many of you have seen a yield curve? Anyone? No one? I don't know whether you can see it. Let me. Okay. Can you all see this? Can?
Yes, sir.
Okay. Now on your x-axis, and this is your y-axis, right? So x-axis, you have the time, 1, 2, 3, and so on. So these are years. Y-axis can or cannot. Can you see this one?
Yes, sir.
Okay. So what is this? This is a typical graphical representation of a yield curve, right? So x-axis you have years, maturity. Y-axis interest rate. So what does it mean? There's an instrument. If it is a 1-year instrument, this is the interest rate. I put IR1. If it's a 2-year maturity instrument, this is the interest rate IR2. So basically, this is a graphical structure of interest rate representing maturity and the interest rate. Okay, so that is called the yield curve, right? Now, what sort of a yield curve is this? Anyone who probably would have definitely in your banking life, you would have heard about these things. What sort of a yield curve is this? Anyone at least who have seen a yield curve before? We call different names. I will come to that, but what sort of a yield curve is this? The one which I have written here.
Upward sloping?
Yeah, upward sloping yield curve, because the slope is upwards. Slope is upward. So what does it mean? When the maturity is, the maturity period extend, you require higher interest rate. But generally we see upward sloping yield curves. That is generally we see, but not necessarily. Not necessarily. Right? Clear? Everybody can see this. I heard from one, but what about others?
Yes, sir.
Okay. So this is a upward yielding, upward sloping yield curve, right? So yield curve is a relationship between interest rate and the maturity of a interest related instrument, right? So when you take decisions for whatever, investment, loans, anything, this is the prime thing you look at. What is the nature of the yield curve? What is the nature of the yield curve? Right? Clear? Okay. So let's move back to the presentation. Okay, can you see?
Yes.
Okay. So so on a given day, the relationship between the rate on short and long term. So that's why I put 1 year, 2 year, 3 year, 5 year. This can extend up to 10, 15 years, depending on your country. Now, if you look at countries like US, they have investment bonds like 30, 40 years. So the yield curve maturity will expand up to 30 years. So you can have a very focused vision on long-term interest rate as well. So the yield curve shows the relationship between interest rate payable on an instrument with different maturities for that given day. The relationship observed between short and long-term securities will be different at a different point in time. So that's what I said. Now, I showed you a upward sloping one, but every day this may change, depending on different expectation of the interest rate market. Now, currently, if you see what is the appetite, again, I am asking this appetite. And appetite, no, not rather than, appetite or appetite, what you call, people like market participant would like currently, what sort of instrument? How many of you are working in treasuries or related? I think you must know this. Current environment, appetite for which maturity securities?
Short-term
maturities.
Yeah, short-ended maturities currently many investors prefer. So there's a greater pressure on short-term rates compared to the long-term, right? You see? So sometimes in countries, you see, there's a greater demand for shorter term than the longer term. So that short-term interest rates are higher than the longer term. In such case, you will see what sort of a yield curve? Downward yield curve. Downward yield curve, right? Okay, so that depends on how market participants look at the future movement of interest. So they are how they perceive that. Okay, so that is factored into the market interest rate. It is something not done, artificially. It's naturally happens. Now these things, it's like how do you decide, the price of a vegetable in the market? Now, if you go to the peta market or fish market, let's say yesterday current price was, 100, today 200. Who decided this? Who decided? One is demand and supply matter, right? That is one main fact. If the demand goes up and supply goes down, then natural hike. But then, how did you decide whether it's from 100 to 150 or 200? No one knows. Today, nowhere in the world you find the answer to that question. So the market automatically determines, okay, this is I want for this maturity. This is I want for this maturity. It automatically happens depending on how the market participant sees the requirement of funding in the market. Requirement of funding in the market and availability of the funding in the market for current and future, right? So yield curves, good thing, are forward looking. When you look at a yield curve, we can forecast for the future to some extent. So if you finally decompose, what do you mean? Decomposition is divided into different components. Ultimate price means ultimate interest rate is an element of 4 components. The real interest rate, that is the real interest rate in the economy. Real means without inflation. Expected inflation, right? The real rate, expected inflation. Now, when a bank give a loan to me, bank need to factor that, inflation. If I lend my money to you as a deposit, I am also lending your bank. How I am lending, I am putting my money, means I am lending. I ask you to pay, okay, 5-year deposit, this much. Okay. So, you give me 5-year deposit, 5% means I am satisfied that I am getting 5% which cover my real rate, expected inflation, liquidity premium. Now, liquidity premium is through what? Maturity. That's why people ask for higher liquidity premium for longer maturities, generally. So, liquidity, risk premium, the risk of the money, risk premium. Like from a bank's perspective, whether it is recoverable or not. So if you look at interest rate, 4 components: real interest rate, expected inflation, liquidity premium, and the risk premium. Okay. So when you say 15% of interest rate, it would have covered these, mainly these elements. These are the typical elements that you should cover up in the 15% interest when you say 15. If you say 13%, then these are the elements. So if you look at interest rate among different banks, it may be different. Because how they perceive, because real interest rate will not change. It is there in the market. But how they perceive inflation, how they perceive the liquidity premium, how they perceive the risk. That's why if I go to bank A, 5-year loan, monthly repayment, they will say, I will offer you at 13%. If I go to another bank, same 5-year loan, same monthly installment, they will say, monthly installments, they means the monthly payment, they will say you pay me 14%. How come? Because they see these elements differently. Okay. So let me come to the previous thing I mentioned, structure of interest rate, the positively sloped. So the first one which I mentioned, positively sloped. Then the B negatively sloped. Because the positive slope means you expect either possible interest rate rising trend or maybe higher liquidity risk premium assigned based on the term structure. When the term structure increases, then probably positively sloped. Then negatively sloped. It is also possible. You don't see, let's say, an economy heated economy. In a already heated economy, probably less cash, more demand, short of liquidity. So shorter end, you have to pay a higher price. But you foresee over long term, 5-10 years time, this will gradually ease so that you will pay a lesser price to long term maturities. So negative slope. Then maybe hump shaped. We don't have much experiences, but it is possible. Term structure maturity hump, maybe little bit up to certain period go up. Again, after certain maturities would be down. So maybe certain countries have experienced this sort of, curves also, depending on the way they look at. Okay. Then flat. Usually flat means the risk neutral like risk neutral. They are not worried about the risk. Whether, you invest in a 2, 3 or 5 years, you get the same interest rate. Right? As securities provide you the same interest rate. Right? So that is called the flat interest rate structure. So these are the 4 possible interest rate structures you usually see. The positively most commonly see. Also, you can see negatively sloped yield curves, hump-shaped, and the flat yield curve, right? Then let's see interest rate risk. Okay. So when you say interest rate risk, there are 2 important aspects. One is earnings aspect, other is value aspect. Okay? Because whenever the interest rate changes in the market, either earnings are affected or the value is affected. Right? Now, both earnings and value impact ultimately result in impact in the capital. Right? Either the impact could be on the earning side or the value side. Whether it's on earning side or whether it's on value side, ultimately impact will be on the capital. Right? Because why it is on the capital? Now, if you look at earning side, the impact could be on interest income. As a result, net interest income, the spread, ROA and ROE, right? So either interest income can go up or go down as a result of changes in interest rate. Okay. And similarly, interest expenditure could go up or go down. So ultimately, net interest income would either go up or come down, resulting in change in spread. And bottom line is profitability. That is return on assets and return on equity. Right? When the profitability affected, whatever the reserve created, retained earnings are absorbed to the capital. If there are less retained earnings, less transfers to the reserves and the capital. If there are losses, then capital will be impacted negatively. So that is the earnings impact. Then on the other side, value impact. Now value impact comes from your trading part. The earnings impact comes either from trading part or banking part. But I'll say non-trading part. Now, if you take a loan book, the interest rate ups and down will affect the loan book, loan income, interest income, but no impact on the value. But if you take a trading portfolio, okay, then impact would come from the value part. Investment portfolio, loan portfolio, deposit portfolio. Now, if you look at loan portfolio, especially if there is a trading part, otherwise there is no value impact. But here in Sri Lanka, we don't have much, loan books trading used for trading purpose, right? In some countries, you can trade on your loan book, right? Investment portfolio means, when you buy securities, interest rate securities for buying and selling. Okay. Ultimately, will affect. Now, of course, in theory, we can say effect on deposits value, but practice, there is no impact because of deposits is a fixed liability. Whether market interest rate changes or not, you have to pay the deposit. So on value part, there is no significant real impact. So ultimately, the value of the capital also changes. Okay. So at any time, financial institutions hold both assets and liabilities. So you have both assets and liabilities. Movements either up or down will impact on profitability if assets and liabilities are imbalanced, mismanaged, primarily because of a mismatch in the asset and liability maturity profile, resulting from the intermediate function. Right? Now, if you look at the risk arising from, like now, remember liquidity, we mentioned due to liquidity risk arise due to maturity mismatch. Short-ended liabilities, long-ended assets. So there's a mismatch of maturities of assets and liabilities, right? But when you take the interest rate risk, again, maturity matters when it comes to interest rate related assets and interest rate related liabilities. Not all assets and liabilities, right? So when you have, we will discuss later in detail, when you are to reprice different amount of liabilities which are interest related in the short term to different amount of liabilities which is interest related long term, that mismatch create the interest rate risk, right? So the interest rate volatility will increase when the interest rate volatility So the changes, here increase means not the interest rate increase, the changes significantly increase or changes significant, the potential loss also significantly increase. Here this arrow does not mean the increasing interest rate volatility. That means the everyday interest rates are changes significantly. Then your loss also significant. So at this simple level, manifest in 3 different ways. So how the interest rate risk could arise from 3 ways. The refinancing risk in the banking book, reinvestment risk in the banking book, and the market value risk in the trading. So basically, when you think about a loan portfolio, what is relevant is these 2. Or even a interest rate related investment portfolio which is held to maturity, you talk about refinancing and reinvestment risk. We call banking book. Then real market value risk coming from trading book. So remember, so the earnings part will be related to the banking book. The value part will be related to the trading book. Right? Clear? Any questions so far? No? Right. We'll take example for the reinvestment risk and the refinance risk. I'll take a very basic example. Bank mobilize a deposit of 10 million at 4% for 2 years, right? Now bank mobilize a deposit of 10 million at 4% for 2 years. Okay. Now let's say bank invest this for a shorter maturity asset. Let's say very short-term loan for 1 year, right? So the first year, the bank gives a loan for the 6%, right? So then at the end of the first year, bank will get 6% on this loan. Now bank need to earn money for repay this interest and the loan for the second year, because you have to match the interest cost. Now second year, let's say interest rate come down to below 6%. What happened? If the market interest rate after 1 year comes down below 6%, then what would be the impact? 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 Anyone?
The net interest margin will thinner. It become thin.
Okay, but before that, put it in a very simple way. What is going to happen? Now, after 1 year, now bank will get 10 million back, right? So what they have to do? They have to reinvest this 10 million in maybe loan or whatever asset at a lower rate now. Okay, so it's not 6%. So what happened? The interest income will decline now. But interest expenditure already fixed at 4%, right? Interest expenditure already fixed at 4%. which you can't change. So instead of 10 million, let's say simplicity 100 million. So it's maybe much comfortable. Let's say 100 million. So if it is 100 million, how much bank should, don't know whether I have an example. No. If it is 100 million, how much bank should pay for this deposit at the end of each year? Let's say it's annual payment. How much bank should pay if it is 100 million? Simple interest. I am asking simple interest, how much they should pay.
$4 million.
How many? How much total? At the end of 2 years?
8 million.
8 million. So every year they need to pay 4 million, simple interest rate 8 million. Now, in order to give this customer 8 million, bank should in turn at least earn 8 million from the investment. Right? Now, let's say first year they made 6%. That means they, let's say again, 100 million loan. So first year they made 6 million. Okay. So the second year, now interest rate have come down. If the interest rate didn't come down, okay, let's say interest rate didn't come down. Okay, so the bank can invest this loan for another year at what rate? What rate?
6%.
6%. If the interest rate no change, bank can lend another loan for 1 year at 6%. So the total income from this loan would be 6 plus 6, 12 million. So banks earn 12 million, bank pays 8 million. So there's a net margin of how much? 4 million, right? Now interest rate reduced to 4%, market interest rate. So now bank can invest or give a loan at 6%, bank need to give at what percent? 4%, right? So now after the interest rate coming down, what would be the total income from the loan?
10 million.
10 million. So what is the spread now?
2 million.
2 million.
2 million.
2 million.
2 million. Now the bank spread is 2 million, right? So earlier it was 4 million, now 2 million. So what caused the interest rate to the interest margin to come down? The reduction in market interest rate. So by chance, if it comes to 2%, what happens? Let's say if the interest rate comes to 2%, then basically there won't be any margin. So that is the reinvestment risk. That is impact of a decreasing in interest rate in a long funded position. So that is called the reinvestment risk. This is the earnings effect impact. Interest income, net interest income, spread then ROE and ROE, right? So that is one element of interest rate risk. We call the reinvestment risk, right? Because of a long funded position. Clear? So maturities of liabilities are greater than assets. When maturities of liabilities are greater than maturities of assets, and interest rate decrease could adversely affect the net interest income. That is called the reinvestment risk. Let me go to another example, refinancing risk. Now take a other way around. You have a short-ended liability and a long-ended asset. You have a short-ended liability and long-ended asset. You mobilize, let's say instead of 10 million, we take this 100 million case. Let me see whether we can change it now itself. No, okay, that's fine. So you mobilize 100 million liability at 4% and give that 100 million as a loan to another party for 2 years at 6%. Right? Clear? So you mobilize 10 million for 1 year deposit and give that 10 million to a person for 2 years at 6%. So let's say interest rate will not change. Now after 1 year, what happened? After 1 year, what happened? What you have to do after 1 year? What do you have to do after 1 year?
Need to repay the, we need to give the deposit value to the customer.
Okay, you have to pay the deposit back to the depositor with interest of 4%. Say 100 plus 4, 104, you have to pay deposit 100 million plus 4% interest, you have to pay him 104. But do you have cash now?
No.
You don't have cash because you invested entire 100 million for a 2-year loan. Now you don't have cash. So what do you have to do? What do you have to do? I am asking very basic, simple question. What do you have to do? So can you say the customer, Anedia, please come after another year because I have given you 100 million to a person for 2 years. So once he settle after 2 years, please come, I will pay you. Is that what you are going to say?
You have to borrow.
You have to mobilize a new deposit, let's say deposit, from another person at the prevailing interest rate and settle him. So let's say the market interest rate will not change. Market interest rate will be 4%. So easily the bank can borrow or maybe mobilize a deposit from another person for 100 million at 4% and settle this customer. And at the end of that year, second year, when he get the loan proceed, can settle the second deposit, right? Now, if interest rate won't change, how much bank would end up? Net interest margin, simple, we'll forget about compounding interest, everything. Very simple interest terms. If the customer has to pay for the loan at annually simple interest, how much would be the bank spread?
4 million.
4 million. Yeah, 6 plus 6, 12. 4 plus 4, 8, 12 million. Now, let's say after 1 year, now when the customer, the bank want to settle the depositor, interest rate rise. Interest rate rise. Now, can the bank raise at 4%? No. Because the new depositor will ask, okay, now market interest rate for 1 year deposit is 6%, give me 6%. So bank has to refinance the existing liability at a higher interest rate. So now bank pays 6%. The total cost of the deposit would be 10%. Now margin has come down to 2 million. Earlier, 4 million. So this is called the refinancing risk. This again affects the income. Net interest income came down. Right? Spread came down, ROA and ROE come down. This is called the reinvestment risk. Refinance risk. Refinance risk. So you have to refinance your liability after 1 year period at a higher interest rate. So when you are shorter funded position, that means you have a maturity of asset greater than liability. When the interest rate rises, your interest income will be adversely affected or the negatively affected, right? Clear? So these are coming from the banking book. Refinance risk, refinancing risk and reinvestment risk. Right? Any questions? So this is what you face every day in your bank. You don't see this, but this is what is happening. If today you give a loan at a particular percentage, you fund at a particular percentage. After 1 year, 6 months, interest rate have changed. Your maturity profile is different. Your impact on interest income is significant. Depending on the movement. Now, for example, let's say in this case, interest rate decline. What happened? Let's say second year interest rate decline. Then bank is better off. Why? Bank can mobilize the new deposit at a lower rate than 4%. Lower rate than 4%. Right? In that case, bank would, spread will go up. Spread will go up. Right? So that depends on the interest rate movement. Not always it is a disadvantage, but we don't know. We don't have control. The danger is that you don't have any control. Now, 2 weeks ago, suddenly market interest rate started going up with the policy rates go up. Right? So with that, your trading portfolios were negatively impacted. Especially you were holding trading purpose with interest rate rise. The negative impact. So that is the danger. So that is called the refinancing risk. So the two components we discussed, reinvestment risk, refinancing risk, both arising due to repricing of assets and liabilities in the banking book. Okay, any questions? Because we don't have time to go through the sources and the models. Any questions before we end the session for the day?